Okay, so that we're clear, we've talked about two inventory systems. The two systems that we've talked about, or we just mentioned, we went over perpetual inventory and we discussed periodic inventory. After we make a determination which one of those we're going to be using, and mind you, in most cases, companies don't really have a choice. What typically happens is an industry has adopted a system, and so for the most part, if you are in that industry, you're going to adopt the same. The reason why you're going to want to do that is because if you're using something different than others in the same industry, then you risk presenting information that people cannot compare your company to companies in the same industry. Therefore, if you're the only one out doing something that's a little bit different, and it turns out that your books or your numbers look better, and somebody ends up losing money on their investment in your company, then you're putting yourself at risk to be sued because you might have misled a company, because your company's your numbers look better only because you used a different inventory method, only because you used a different inventory system. So we're going to follow the industry standard by using whatever the industry uses. We'll follow that inventory system, which makes our lives easier. We don't really have much of a choice. Now, after you choose, or after that's been chosen, which inventory system you're going to be using, you now have to then decide on what inventory cost method you're going to be using. And this often is referred to as cost flow assumption, cost flow methods, inventory cost methods. You may see that. I may use those terms interchangeably. So if I do, just know that I'm really talking about the same thing. So methods is not systems. We learned the two systems. Now we're going to learn different methods. Okay. So what we're going to understand and learn about is that the different methods can impact profits reported, the income tax paid, because the income tax paid is associated with profits. And it'll also impact the values of inventory, turnover, and the gross profit percentage ratios. So naturally, we're going to be inclined to use whatever cost methods, and we're going to look over a few of them right now, but we're going to be inclined to use the cost methods that actually put our company in the best light, especially if we're a for-profit organization and if we answer to investors and shareholders, or maybe we're a publicly traded organization, so our stock price is really depending upon what people perceive our company to be. And if something makes us look better in terms of profitability, well, that's what we're going to want to use. Again, even though we want to use something, in most cases, we're going to be inclined to use what the industry uses because we don't want to mislead investors. So when we're talking about inventory cost methods, we're going to look at 4 of those different types of methods that can be used. Those 4 include specific identification, average cost, first in, first out, or what we refer to as FIFO, and last in, first out, which is referred to as Lifo. The first method is referred to as the specific identification method. And this one actually, at first, it might seem as, well, that's the way it should be done. That's the way all companies should do it. Why don't we always do it this way? And so let's take a look. Specific identification method is used for businesses with unique inventory items. Examples would include automobiles, antique furniture, and real estate. Businesses cost their inventories at the specific cost of a particular unit. Specific identification method can be too expensive for inventories with common characteristics. And this will make a lot of sense to you because we're going to be tracking everything that we buy and what its specific cost is. So as an example here, we started off with a beginning balance of 10 units at $10. So the total amount of inventory that was purchased was $100. So simultaneously, I'll go ahead and update the T accounts in our spreadsheet so that I go at a pace that will help us understand a little bit easier what's going on. So we've purchased, let's assume that we purchased this and the credit is to accounts payable. Let's say that's a beginning balance as well. Now we made two purchases. The first purchase we made was for 25 units at $14 each. That's the kicker when we're talking about inventory, is when we buy goods, the goods do not always stay the same price. In fact, I can almost guarantee you that the price will be changing all the time. Prices, even for products that are not too volatile in terms of their price, they change. And in most cases, they change by going up because of natural inflation, right? Let's assume that we purchased in our first purchase, we purchased 25 units. And we purchased it at $14 each. Okay, so we extend that price out. So we debited our inventory for $350. We'll call that P1. Now, so that we've got the whole picture here, or a bigger picture here, we'll go ahead and credit inventory again for the same purchase. Now, we made another purchase, and we bought another 25 units, but in this purchase, it was for $18. 25 units at 18. So the total extended price is $450. 25 times 18 gives us the 450. So that's P2. And just to be consistent, we'll go ahead and credit accounts payable. Now it appears, based upon what I'm seeing here, it appears we're going to credit inventory. And we're going to credit it for 40 units. Well, we sold 40 units. We're going to credit it. But that's the kicker, is we started off with 10. We bought 25 plus 25, which means we bought 50 units. The total amount of units that we have that are going through our inventory is 60. We have 10 plus 25 plus 25, that's 60 units. Now it appears in this example here, they're telling us that 40 units sold, but the question becomes, well, what 40 units were actually sold? So you can see some units are at 10, some are at 14, and some are at 18. When we sell it, which one of these were actually sold? Was it the $10 units? Was it the 14? What was it, the 18? That's what can get a little bit confusing and a little bit more complex in terms of how to account for this. We know we sold 40 units, according to this example here. If we sold 40 units, we started off with 60, we sold 40, then we're going to have 20 units remaining. Well, what did the 20 units cost? What was the cost of the 40 units that were sold? And what's the cost of the 20 units that are still remaining in inventory? Using the specific identification method, let's go ahead and assume that we sold 10 from the beginning balance. We sold another 20 from the number one purchase, or purchase number one, and then we sold 10 from purchase number two. So we had 10 plus 20 plus 10, that's the 40. The problem told us that we sold 40 units. Now, since we're using specific identification and we know which units we sold, then we just need to identify what the cost was of each one of those items that we sold. So the first 10 the cost was $10 each. For this first purchase, it was $14. And for the second purchase, it was $18. So when we're trying to figure out the cost of the goods that we sold, we'll take the 10, multiply it by the 10, that's the $100. We'll take the second 20, we'll multiply it by the 14, and we'll take the 10 and we'll multiply it by the 18. So we have $100 for the beginning balance. That was specifically identifying the beginning balance is what was sold. We also specifically identified that 20 units were sold from the first purchase, which was at $14. So the cost of those 20 units was $280. And then we specifically identified that we took 10 units from P2, or the second purchase, which that purchase was for $18. 10 times 18 is 180. So if we add those up, the total cost of the inventory that was sold is $560. we have specifically identified that $560 of the inventory was sold. So what are we going to do? We're going to debit the cost of goods sold for $560, and we're going to credit inventory for $560. Now, what that's going to leave us with, using specific identification, what that's going to leave us with is a balance of $340. So this represents the cost of goods sold, 560, but now our inventory is going to be made up of, well, there's none of the 10 units is here anymore. So beginning balance is gone, but we have a few of the first purchase. How many do we have left? We have 5 remaining. We bought 25 on the first purchase. Let's go back and look. Yep. Number 1, we bought 25, but we specifically identified that we sold 20 of those. So what's remaining is 5. Now that cost on the first purchase was 14. So now we'll take the 5 and multiply it by the 14. So the dollar amount that's still going to be in inventory is 70. We sold 10 of the items that were purchased in P2. There were 25 units that were purchased in P2 for $18. So we sold 10 of them. That leaves us 15. The 15 that are remaining were purchased at $18 each. So the price is $18. 15 times the 18 is $270. So we're going to add the total of inventory, and that should equal $340. Now, what is it that we need to know? Well, lo and behold, look what our ending balance is that we had already computed. When we took the 560 out and put it into the cost of goods sold of 560, the remaining balance ended up being $340. So by nature of taking the 560 out, we ended up with the balance, and the balance is made up of 5 P1s and 15 P2s. That would be the example of specific identification. You are identifying specifically what was sold. Now, the example in the PowerPoints didn't quite go into that level of explanation, but hopefully by me showing you how that all flowed through using the T accounts in the spreadsheet, it might be a little clearer on how specific identification works. Now, for some reason or another, it has been determined by management, by the company, that to do it in that manner is too costly. And again, when you're thinking about working at Walmart, Target, nearly any retailer, all of them are using technology, so it seems almost ridiculous. But if you really think about it, it doesn't quite make sense if you're using something like a liquid of some sort. And the reason being is, if you're pouring, let's say a gasoline place, if you got these underground storage tanks for gasoline, retailer, gasoline gas station, they have these underground storage tanks, and they have trucks coming in constantly. I've never worked for one, so I don't know how frequent, but I would imagine it's, I don't know if it's more than once a day or a few times a day, but certainly a few times weekly. They're going in and putting gas in those tanks. Now talk about a volatile price. Gasoline goes up and down daily, right? So when they're purchasing this gasoline and these trucks are coming in and putting it into the gas tanks, they're not separating, well, this gas here costs this much and this gas, it all gets mixed up. Now specific identification becomes a bit of a challenge, right? How do you, when I go pull my car up and I start pumping my gas, which gas am I putting in my car? Am I putting in the gas that they put in this morning? Or am I putting in the gas that they put in yesterday morning? it's not quite as obvious. Now everything is kind of mixed up. So when you have a situation where it's going to be too costly to try to figure out specifically what's being pulled out of inventory, then you've got to come up with some other methods. The first one we're going to talk about is average cost. This is also referred to as the weighted average method. And this one's probably going to be very intuitive as well. It's going to be based on the average cost of the inventory during the period. So in other words, the product is purchased, and then whatever's taken out goes into the cost of goods sold, and we're just going to use the average cost of everything that's purchased. And we're going to update our inventory records in that manner. Here's the same example that we worked on for specific identification, but now we're going to use the average cost method. And since we couldn't specifically identify which units we actually sold, we're going to take the average of those costs to be able to figure out how much of it is going to remain in inventory and how much of it is going to be put into the cost of goods sold. So as an example, we have the $100 that we purchased and number 1 and number 2, and just like we did in the previous example. Once we've got the numbers, we still know that 40 units are sold, but we don't know what cost to apply to it because we don't know which one of these were sold. So we're going to use the average. And the way we're going to compute the average is we're going to take the cost of goods available, which in this case is $900. You say, where did that come from? Well, 100, 350 plus 450. So we're going to add everything that was purchased, or the purchase plus the beginning balance. The beginning balance plus purchases gives us the goods available. That's $900. Then we're going to divide that by the number of units that are available. Well, we'll use the same computations, the beginning balance of 10 plus the purchases of 25 and 25. These are the units we're working with, and these are the costs we're working with. 900 divided by 60, these costs here. And that's going to mean that on average, our average cost for those purchases was $15. At this point in time, we just need to know how many units were sold and how many units are still in inventory. Well, we know 40 units were sold. So if 40 units were sold, we're going to take 40 units and we're going to multiply it by the $15. $15 times the 40 units gives us $600. That becomes our cost of goods sold. Our ending inventory, well, is the remaining units, 20 times the 15, and that gives us $300. So the way it's going to work is we're going to compute the cost of goods sold. By the way, this is the average cost method. So the cost of goods sold is going to be the 40 units multiplied by the cost, which was, well, in this case, it's the average cost, which was we computed to be $15. So the cost of goods sold is going to be the 40 units multiplied by the 15, and that gives us $600. Inventory is going to be the remaining units, 20, multiplied by the $15, and that's going to give us $300. So the total we're accounting for is 900, which we know that to be the case because 100 plus 350 is 450, plus 450 is 900. So we're accounting for this $900. The only question is how much of it is the cost of goods sold and how much of it is still in inventory. So once we know this, we're going to make a journal entry. And that journal entry is going to be a debit to the cost of goods sold for $600. I'll call it S1 because that's the sale. Just remember though, we're not even talking about the sales price. We're just working with the inventory and the cost of goods sold. So we debited cost of goods sold for $600 and we're crediting inventory for the same. So we have the cost of goods sold of $600, the ending inventory balance of $300. We're accounting for the $900. That's the $900 that we originally purchased. We take $600 away and we're left with an ending balance of $300. That's consistent with what we computed the ending inventory to be. The average cost method showing the T account for inventory shows $300 is our ending balance. Okay, so far we've gone over specific identification, and then we went over the average cost methods. Those are two methods that we've already talked about. The third method we're going to talk about is referred to as the Fifo method. And the Fifo method is first in is the first out. So if we take the liquid example again, we're going to put the drain or the pipe out at the bottom. The first that came in is the first that goes out. First in, first out. This is probably close to 90+% of all inventories really follow this method because it makes sense, especially if you have something that is perishable and you don't want old inventory sitting around. I mean, you don't even want it for durable goods because at some point in time things get too old or they get obsolete. So really ideally in almost all cases you're going to want the first in to be the first out. The first in that comes in that you purchase is the first that's sold. Well, this is the assumption that we make with our costs, all right? So let's take a look at how this works. Well, we have the same 60 units that we purchased, 10 plus 25 plus 25. The same $900 that were costed out. The only thing we really know at this point in time is that we've sold 40 units. So let's go ahead and take a look at what that's going to look like. So if we assume the first in is the first out, so accounting for the cost of goods sold. The FIFO method says whatever was the first in is the first out. So really, we're accounting for 40 units. And we're trying to account for the cost of goods. So what was the first thing we had? Well, our beginning balance, we're accounting for 40 units. Our beginning balance was 10 units, 10 units. Well, if we sold 40 and it's first in, first out, those definitely got sold, right? So those 10 units were at a cost of $10. So we know that all those 10 units are gone. $100 is part of our cost of goods sold. Remember, we are accounting for 40 units that were sold. We've only accounted for 10, so we need to figure out, well, there's still another 30 units that we have to account for that were sold. So now we go to the next purchase. Well, P1, there were 25 units that were sold there. Well, let's see, that would put us 25, that's 35. So definitely that was a part of it. So 25 units, and those were at $14. Those were first in. And so now the extension is 350. So all of what we had in the beginning inventory, that was in there first, plus all of the first purchase, gone. 100 plus 350. But that's only accounting for 35 units, and we sold 40 units. So another 5 had to have been sold from where? Purchase number 2. Purchase number 2 was at $18. So that extension is 5 times the 18, which gives us $90. We're going to sum this up. And so the cost of goods sold ends up being $540. Well, therefore, we can then, without doing anything more, we already can just put $540 here as the cost of goods sold, sale 1, and we're going to credit inventory for $540. Now, accountants always like to confirm numbers, so let's go ahead and compute our inventory. Our inventory that's remaining, well, we bought 60 units, 10 plus 25 plus 25, total of 60 units, and we sold 40, so that means we have 20 remaining. 20, so 20 units are remaining. Now we've already used up this batch. That went out with the cost of goods sold. We used up all of the second batch as well. That went out with the cost of goods sold. So what we're left with is our most recent purchases. Our most recent purchases were at what price? 18. So all of this 20 that's remaining were part of this 25 purchase, this 25 units purchase, number 2. And they were purchased at $18. So 20 times the 18 gives us 360. So what I'm suggesting to you is, based upon our computations, we should have $360 in inventory. Well, let's take a look. Our ending balance would be beginning inventory plus purchases minus what we recognize as the cost of goods sold. Bingo. $360, $360. That is the FIFO method. So we've talked about specific identification. We talk about average cost. We just went over FIFO. Now we're going to go over LIFO, last in, first out. And you can think of this in terms of, what it might look like in an inventory is that your tap is at the top of the tank. Instead of at the bottom where the first in was the first out, the last in is the first out. If the tap is at the top, that's exactly what's happening, is you're pulling out from the top of the tank. So what this suggests is the Lifo costing is the opposite of FIFO, and the last cost into inventory go immediately to the cost of goods sold. So let's take a look at what that would look like if we were computing Lifo. And what we want to do is look at the cost of goods sold. How do we compute that? Well, what this is suggesting is that the last in is the first out. Now we're accounting for the 40 units and we're trying to figure out what the cost of goods sold. The last in is the first out. So let's see, we've got 40 units. Well, let's take about this first purchase here. This first purchase here, P2 was the last purchase. P2 was the very last purchase. Last in, first out. So that's going to be the first part of what goes out. Well, let's go to number 2. There were 25 units. Well, there were 25 units there. The 25 units were at a cost of $18 per unit. So that means $450 will be charged to the cost of goods sold. Now, we're accounting for 40 units. We've only used up 25. So what's left, what we have to account for is another 15 units. Let's go to P1. Remember, we're going backwards now. It's P2 was the last, and well, the one that was last before that was P1, and that's 25 units. Okay, well, this 25 units is going to really account for the remaining units that we have to, or that we sold. So we sold a total of 40. 25 have already been accounted for. We need to account for another 15, and that's included in this 25. So 15 times, what was the price? $14. So now our cost for those 15 units is $210. Now we're going to add this all up. And so our cost of goods sold in this example here is 660. So let's go ahead and debit our cost of goods sold for 660, and then we'll credit inventory for 660. And what that gives us then is we're going to take our beginning balance plus our purchases minus the cost of goods sold, what we took out. And so our ending balance is now 240. So 660 went to the cost of goods sold and 240 remains. Now let's confirm this. So we're going to look at what's remaining in inventory. How many units are in inventory? You guessed it. 20 units remaining in inventory. Well, now we're going to go the opposite direction. What do we know? Since our last purchases are the ones that went out, then what's still remaining are our first purchases. Well, the very first purchase was what we started off with beginning inventory. And see, there was 10 units there. We're accounting for 20 units. So, definitely that's there. So 10 units times $10, which then gives us $100 cost. We're accounting for 20 units that still remain, so that means that another 10 are still unaccounted for. Well, that can go from P1. That P1 is purchase one, number one. There's still 10 units there, and that was at 14. So we'll go 10 units there at 14. So there's 140. We're going to sum up our inventory, and lo and behold, we come up with 240. And that's what's equaled here. This is the last in, first out. This is how it looks like using the Lifo method, using the T accounts. We have 240 remaining, 660 was pushed over to the cost of goods sold. Let's assume that with the last three methods we looked at, average cost, FIFO, and LIFO. When we're looking at the impact of these different methods, we can simply we can see how the different methods might impact income. So we'll look at sales revenue, cost of goods sold, and then we can then compute what is called gross profit. Now we're leaving out specific identification, and this is why. For the two inventory systems, we had perpetual and we had periodic. When we're using the perpetual, remember I told you that was technology. In almost all cases, when we're using perpetual and technology, we'll just go ahead and use specific identification. And we're done with that. Now we move on to the periodic system. And within the periodic inventory system, we now look at the three different alternatives, and that is FIFO, LIFO, and average cost. So under the three, the sales amount are going to be the same because the methods had no impact at all. The sales are based upon what the sales people can generate for you. But we do know that under these three different methods, the cost of goods sold was different. Let's review. Let's assume that on using the example of the 40 units that we sold, what we sold was 40 units. We sold them, if we sold it for $1,000, we sold them for $1,000. Now the cost of goods sold under each method was different. So let's go to FIFO. Let's see, which one was that one? I think it was this one. No, that was average cost. If we go back and look at the FIFO method, we computed our cost of goods sold to be $540. It's listed here on the spreadsheet. It's also listed on the slides. $540 is what we charge to the cost of goods sold. So we'll do that. $540 goes to the cost of goods sold. Under the LIFO method, we computed the LIFO amount. The cost of goods sold was $660. The cost of goods sold amount was $660. So we can update under LIFO, the cost of goods sold is $660. And under the average cost method, we computed our cost of goods sold to be $600. Remember, we charged the cost of goods sold $600. So here we can see that the gross profits change as well. From the FIFO method, we generated $460 in gross profit, $340 for LIFO, and $400 for the average cost. What this tells us, this is also on the slide. Let's go ahead and take a look at the slide. What this tells us is that in the example that we just looked at, we generated more income using the FIFO method. Now, why did that work out? In this example that we used, we have to remember this. During periods of rising prices, when the prices are going up, FIFO is going to be generating more income. LIFO will be generating less income. Now, why is that? The reason being is because the cost of goods sold during using the FIFO cost of goods sold is lowest because it's based on the oldest costs, which are lower, generally speaking. So gross profit is therefore the highest. Now, this is true if prices are going up, which in most cases there are. So the ending inventory will be highest because it's based on the most recent costs. which are generally speaking higher. That isn't always the case. You can't say this 100% of the time, but in most cases it will be because prices generally go up. Under the LIFO method, the cost of goods sold will be highest, and so therefore you will have the lowest amount of income. Cost of goods is higher, income will be lower. Why? Because the cost of goods sold will be charged the most recent costs, and those will be higher in most cases. What remains in inventory in LIFO actually will be the lower cost. They were the oldest costs, so they will be lower costs. Therefore, your inventory levels will be lower. Now, this holds true when inventory costs are increasing. In other words, the prices are going up. When inventory prices are going up, when costs are going up, this is what happens. If you think about it, if you flip it, if inventory prices are decreasing, meaning the price of product is going down, you're like, when does that happen? Well, gas as an example, sometimes the price does go down. FIFO will generate the highest cost of goods sold and the lowest profit. The ending inventory will be lower because it's going to be based on the most recent costs, which are lower. Under the LIFO method, the cost of goods sold will be lower because it's based on the most recent costs, which are low, and gross profit will be the highest. Therefore, under LIFO inventory, ending inventory is going to be highest because it's based on the oldest costs, which are higher. This is kind of, if you can get this down, you've got inventories down, because this is probably the more, it's not complex, it's just trying to remember everything in its relationship. Now, having said that, there are some tax advantages to using the LIFO method, because generally speaking, prices are going up, right? Generally speaking, you're dealing with the first example that we looked at where prices are going up. And so therefore you're going to be generating a higher cost of goods sold using LIFO. And so therefore you're going to generate less income. But in most cases, we think less income, oh my goodness, that's not good, less income. And for most companies, we don't want that. We want more income. More income is more profits is more distributions to shareholders, especially publicly traded organizations. They're biased towards higher income. But some companies might, who let's say you're not publicly traded, you're a sole proprietorship or you're a small corporation. My company is a corporation. I don't do inventory, so this isn't even an issue for me. But if I did have inventory and I was looking for a way to save on taxes, then I might be motivated to use the LIFO method, especially for tax purposes, because the LIFO method means that I'm going to, generally speaking, when prices are going up, I'm going to generate lower income. Therefore, I'll pay less in taxes. So the example here is just looking at the gross profit between FIFO and LIFO. We computed this earlier. Those numbers came from the exhibit that we looked at, 460 and 340. Those were the gross profits. We subtracted the operating expenses, which are going to be the same for both. So now we take the income before tax and we figure out what the tax expense is, and let's assume 40%. So under the FIFO method, $200 was income, multiplied by the 40%, we're going to get $80. Under the LIFO method, we're going to take the $80 and multiply by 40%, we're going to get $32. Well, which method ended up paying lower taxes? The LIFO method did. Why? Because it showed lower profits. If you show lower profit, you pay less taxes. So companies who are just interested in taxes, in saving on their taxes, might be motivated to use the LIFO method. The tax advantages of LIFO: measuring cost of goods sold. LIFO, more realistic net income figure. Most recent costs assigned to the cost of goods sold under the LIFO method. And measuring the ending inventory is using the FIFO provides more up-to-date inventory costs with the most recent costs on the balance sheet. So, you could see that there's good arguments for both of these, but what we don't want is for management, especially when we're talking about preparing information and report systems to external parties, to manipulate income simply to deceive or to give a better picture, because that could be a manipulation and if you do it intentionally to make your company look better than what it should be, you could be guilty of fraud. So LIFO and managing reporting income, LIFO allows for manipulation of net income. The timing of purchases of inventory, if you might decide that you might buy more inventory at certain times in order to lower the cost or to increase the cost of goods sold and lower your net income. When inventory prices are rising, purchases large quantities near the year end to end up paying lower in taxes. So you can do this, and companies do in fact do this to lower their tax liabilities. And by the way, that is legal. You're not fabricating anything, you're actually purchasing it. So you might be motivated for tax purposes using LIFO so that you end up paying lower taxes. You also have what's referred to as Lifo Liquidation, and that is the quantities fall below the level of the previous period. And when that happens, that you must dip into old layers of inventory costs, shifting older costs, lower costs into the cost of goods sold. So if you're actually getting rid of some old inventory and you're using the LIFO method, you may end up lowering those costs, but you're using older costs that had lower prices. So your cost of goods sold is not going to be impacted as significantly.